Hey Goku, the year's about to start. I made some changes. I got a baby, a bamboo baby. Check it out. See, I did the impossible. I killed the bamboo plant. Not all the way, but most of the way. And because it was an eyesore, I got a new bamboo baby. Hey guys, welcome back to the After Hours. I'm the ATL Beast, and today we're going to talk about slippage. Now, when we talk about slippage, it's usually a small percentage from a specific point. It's usually called a deviation or wiggle room. You have to understand that there is a difference between slippage and clearance. Now, when we talk about clearance, that's the gap between a hard stop and the point where you entered. But when we talk about slippage, that's deviation from a specific point. It's give or take a few percentage. We're talking about if I think that this stock is at $5 and it's going to go to $5.50 before there's some type of reject. Instead of putting my risk management at $5.50, I'll put it at $5.55 or $5.51. Maybe even $5.65. At that point, it's like 3% away, which would be 15 cents on this $5 stock. But it feels a little bit different if we do it on a $20 stock, because that slippage could be 60 cents on a $20 stock versus 15 cents on a $5 stock. Now, how is that actually different if we're talking about a percentage? Well, it comes back down to where the patterns come from. Now, when we talk about patterns, we have to understand that all patterns are based off observations. Now, observations come from the retail traders. These retail traders, they put in a lot of screen time because that's the first stage when you get into trading. You have to put in as much screen time as possible for you to be able to read the momentum in the chart. And when you read the momentum inside of a chart, you're not just going to have obvious resistances, obvious tops and bottoms, and you're not supposed to try to predict those points anyway. Your job is to create a system that can profit off of that volatility. The people that try to guess the top or guess the bottom or risk a specific resistance or support, those are usually fixed systems. Now, these fixed systems, no matter what you do in the market, it's usually going to come back down to a 50-50. Now, when we talk about a 50-50 system, that means 50% of the time you're going to lose. But in reality, we look for setups. Now, these setups, they have high odds. Now, these odds can get up to 85%, while an average is closer to 65%. So when we talk about a pattern with a 65% win rate, you can usually do a tiny tweak that gives you an extra 5% or 10%. Sometimes even 15%. Now, when we talk about people online that show their losses, there's respect to them, but I have to make a correction. The people that said they lost to slippage, they meant it as a term that you can understand. In reality, they probably didn't lose to slippage inside of their stock. They lost to slippage up here. Now, what I mean is they had a lapse in judgment. The only time slippage is really a problem is when you go into a high-risk stock, like a microfloat or a biotech, with a lot of volume and volatility, and you get stuck in a halt maybe. Maybe your slippage kept you from getting out of that halt in time. And when it unhalted, maybe you went up an extra $2. But at that point, was it really slippage that put you in that dangerous position? Were you in a position that you were oversized in the first place? If you had a smaller position, maybe you would have been more comfortable taking that loss right away. Now, I say this because with enough screen time, you can read momentum and you'll understand when these halts are about to happen. And you'll see when the volume comes into the chart. We had a lot of plays this week. Now, we know the holidays is a time for a lot of people to think of family, think of spending money and discounts. But what happens is a lot of people look at discounts differently inside of the stock market. They look at cheap stocks and they think about buying anything low and selling high. If we look at this week, we saw that spikes were everywhere. Just this week, we saw an average spike of 600% across most tickers. Here's a few tickers: NXTP, MSAI, POL, SMFL, and LTRY. Now, with these tickers, you have to understand that most of them are gap ups. But with these gap ups, they're way overextended and they shouldn't be up that high because stocks don't go straight up and they don't go straight down. And two of these are actually decent resistance plays, which are kind of rare this year. One of them is a bounce short. Another one is a gap through resistance. So with NXTP, it's traded its highest volume ever, and also on SSR. If you didn't get in a good position on this, you probably shouldn't have shorted it because it's a fresh chart now. But this is A+ setup resistance play. If you're interested in this type of stuff, check out the links in the description. But this week with the biggest gap, we actually saw POL. Now with POL, This one went up 900%, just a little bit under 1,000. And with that, we know this stock had to have a big rejection, and we expected a second bounce. That bounce wasn't as big as we thought on the second day, but it ended up coming back on the third day. And because there was a delay on that second day, the third day was not as strong. Now, all this was a reasonable resistance play. Now, when we talk about slippage in the long term, it can increase your winning percentage, but it also increases your anxiety. But is it really worth it if you calculate the long-term cost? Over time, your discipline will go down. Remember, the stock market is an ambiguous environment. That means it's an imperfect structure. And with the imperfect structure, you're gonna need a system to try to manage that imperfect structure. And with that, you need a system to manage everything. Now that system's gonna have to be spread into two parts. One part that's imperfect and another part that's fixed. Now, with the fixed part of the system, that's just your comfort zone. That's so you can become consistent, so you can do the basic work, so you can accumulate knowledge over time and know exactly what you're going to make, what you're going to lose. After that point, you're going to have to go to something more imperfect. You're going to have to do things by your own rules. You might involve a little slippage and start using your experience and long-term data and balancing your long-term data with your short-term data so you can properly manage your risk. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.